Hello, good morning, good afternoon, good evening to all of you, and welcome to GSA's webinar series. Today, we're going to be talking about funding the future and how spaceports secure infrastructure investment. Before we get rolling, though, I just want to bring you up to speed with a bunch of things that have been happening at GSA. First of all, I'd like to thank our sponsors, our title sponsor, RS&H, Platinum, American BRPH, Gold, Parsons, and Michael Baker, and of course, Silver, HDR. This whole session will be broken into three pieces. I plan on having some introductory comments, then we're going to discuss the bond situation, and finally look at other capital sources. Since our summit in January, we've added an array of new members. Here we have 5 of them. Next slide. Another 5 all over the world. And this is really starting to add tremendously to our total membership, but not just in the US, but across the world. There's a bunch of things that we're working on right now to demonstrate our world reach. We're linking up with International Space University to put on an online program, and that will take place in the summer of this year. We're also going to be working with Farnborough International Air Show, putting on 2 different panels for them relating to space activities, and that will be on July 21st and 22nd. We're also continuing our International Spaceport Forum program that runs just before the International Aeronautic Congress this year. It's in Turkey on October 4th. And then finally, I want to also just get in your diaries our January 11 Spaceport Summit. This, as you know, kicks off Commercial Space Week, which includes space mobility, Spacecom, and of course, our Spaceport Summit. That's January 11th through the 14th. Our next webinar is June 17, and it will be Powering Launch, Nuclear Systems Testing, and Safe Operations. So put that in your diaries as well. Okay, enough from me for now. What I'd like to do is offer our panelists an opportunity to just briefly introduce themselves and make some introductory remarks. So I'm turning it over to Ron Law, and Ron, you're up.
All right. Thank you, James. Good day, everyone. I'm not going to go and because I know we have people from all over the world, but I'm Ron Lau. I'm the Senior VP of Corporate Development and Capital Programs at Space Florida. So I head up our business development team as well as our capital programs team, and also serve as the interim chief investment officer for Space Florida. And excited to be here. I think I'll refer back to when we did the space special briefing back last August on Spaceport Bonds, when that legislation got passed shortly thereafter. So I think this is going to be a great conversation with the rest of the panel. Space Florida is the state of Florida's aerospace finance and development authority. So in addition to just what we do with kind of the spaceport system within the state of Florida, we also have a broader aerospace purview. So we've had a lot of experience in terms of financing and other developments that we've had in the broader aerospace industry, which covers not just space, but also more traditional aviation, aerospace, and defense. So a lot of what we've done in shaping where things are with Spaceport Bonds also is borrowed from these other industries that we work in. So excited about the conversation. I know that we'll have a lot of other questions, commentary, but I will just pass it off to, I guess, who I see next on the screen, Ed.
Great. Thanks, Ron. I'm Ed Rojas, and I'm a tax partner at Holland in their New York City office. And I've been working in the area of tax-exempt bonds for over 40 years now, with a concentration in financings for transportation facilities, particularly airports, which, as we'll discuss, were sort of the starting point for Spaceport Bonds. In addition, I'm the editor-in-chief of the Federal Taxation of Municipal Bonds, 12-volume set, desk book, yours for $1,300, and very glad to be with everybody else on this panel.
Okay, next. Kostas.
Hello, everyone. My name is Kostas Poulakidas. I'm an attorney with Greenberg, Traurig. Greenberg, just real quickly, is a global law firm, over 51 offices with almost 3,200 attorneys in all areas. I focus on, much like Ed, public finance as well as project finance and infrastructure, working on projects that not only involve kind of the topic that we're going to be talking about today, tax-exempt financing of spaceports, which, as Ed said, is very similar to how airports and other infrastructure projects are financed, but also I deal with oftentimes real estate private equity projects and also economic development and redevelopment projects, which I think we're going to be touching upon in terms of how to supplement an overall larger project. So looking at your project and your goals more globally in terms of generating revenue streams into your projects to support not only government projects, but also the private sector projects that we hope will be moving in and creating space parks, essentially industrial development parks for spaceports. And another aspect of my background is I also served as chief of staff and senior advisor to the chief counsel of the FAA as well. So have that background and understood the FAA's component and how not only the FAA, US DOT and NASA view this as a critical infrastructure project. Look forward to being here.
Jeff.
All right. Well, very happy to be here today. Jeff Phillips. I'm a director with KPMG's Infrastructure and Capital Projects Advisory. We have a wide range of services that we offer on big infrastructure projects, including spaceports, and these range from support around innovative financing to workforce development to strategic planning. I'm here to talk today a little bit about a little bit of a different angle than some of the other panelists on how to potentially get money for spaceports and space parks. I spent a lot of time looking at federal incentives and how they can be leveraged to enable large infrastructure projects, including spaceports. And so, if you've been on a GSA, panel before, you may have heard, well, there's no incentives out there for spaceports. More money went to ferries than ports in the Infrastructure Investment and Jobs Act, and that's all true. But what I've seen is that there's a lot of funding that's available that can support the spaceport and support the companies in the spaceport ecosystem, whether that's developing port infrastructure for maritime ports, whether that's rail infrastructure or workforce development or updating the highways. There's a range of activities that spaceports should be looking at to support their priorities and partners that they should be looking at in order to go after those federal dollars. So looking forward to the discussion today.
I guess Odin.
Hello, everyone. My name is Odin Atkinson. I'm a public finance banker with KeyBank Capital Markets, focused on infrastructure and project finance. My background is in municipal and quasi-corporate public finance, and I've worked with traditional issuers as well as tribes and other public purpose entities. I'd say much of my work really sits at the intersection of government ownership and private operators, and it spans across sectors like seaports, hospitality, and most recently spaceports, where I've been involved with early stage discussions around spaceport infrastructure projects ranging from hangars to workforce housing to industrial development. So I'm really looking forward to the discussion. And James, I'll pass it back to you.
Okay. Well, thank you all for your participation today. What I'd like to do now is turn it over to Ron and probably Ed and maybe others too, to sort of frame some of the issues around the bond financing situation. Okay, Ron, over to you.
If we go into the Wayback Machine and when the genesis of tax-exempt private activity bonds for spaceports, we have to go all the way back to 1991 when this first got introduced to Congress. And it was great intention, but I think everyone would agree back in 1991, there wouldn't have been anyone that could really take advantage of the legislation. If we kind of fast forward through to probably about 5 years ago, we really kind of we at Space Florida had re-examined the language, and I led that effort to really try to meet the industry where it was. So a lot of the things that are in what could be covered with these tax-exempt spaceport bonds isn't just around launch pads and just launch operations. It was much broader, again, to meet the industry where it is. And so it was much more broad than where, say, the airport or seaport tax-exempt financing capabilities are. So we'll work through some of those nuances, but the legislation did get passed as part of the One Big Beautiful Bill last summer. I mean, it was always a bipartisan, multi-state effort. It wasn't just Florida-based. We intended the legislation to be applicable to everyone. So a lot of that thought went into how everything was structured, and we're happy that it did get passed. We do have active pipeline of projects that we're working through, and as we'll talk through, and probably this would be with both Ed, Kostas, and Odin in particular. I mean, the time it takes to really get a project baked all the way through. I think we'll have a slide that really talks about what's really required. It is going to be a game changer, and I think that the market is going to be very excited. We've been talking about it for a number of years to the institutional markets about the new legislation. So now that it's finally here, people are excited. So I think as far as a level set, as I mentioned, some of this is in the GSA special briefing from last August, but I don't know. Ed, why don't you do a little bit of a private activity bond 101, and I guess
Sure.
the others can jump in as well.
Sure. Thanks, Ron. So for those of you who know something about municipal bonds, I guess the shorthand way is spaceport bonds are like airport bonds or dock and wharf bonds on steroids, in that you can do you have the benefits of those types of bonds, namely, one, they're not subject to volume cap, which means you're not competing with money for other uses within a state, like housing being one of the main ones. And that's actually a really big one right there. And then it adds a lot of benefits that you don't have for airport bonds, and that's, I got to give kudos to Ron for handling a lot of the issues that we had here. So let's talk about what's a spaceport, right? So a spaceport. So in order to do spaceport bonds, you have to be at or in close proximity to a spaceport facility. And that's a facility for launch or re-entry of vehicles. So I'm saying vehicles, and I'm not specifically saying it has to be rockets and everything, right? So it says go into, in some places, outer space, but maybe not. Maybe that's not what's required. It's also so think launch pads and control towers and all that stuff. But you can also do things you can't do for an airport, like you can do manufacturing facilities, you can do industrial parks, which means you can have the facilities that are going to actually manufacture the rockets or manufacture the space payload that goes into those rockets, which is a big benefit right there. One of the big things to keep in mind with a spaceport bond, like an airport, is that everything that's bond financed has to be owned by a state or local governmental entity. Think an entity like Space Florida, or if a city or an industrial development authority, they have to own it, because the way that this is going to work is a private company that wants to use these facilities cannot own it. What they're going to do is they're going to enter into a lease in order to be able to use these facilities. And that lease has to be such that the governmental entity still owns it. And basically, it means that the lease can't go more than 80% of the economic life of the facility, and the lessee can't claim depreciation and investment tax credit. So that's an important thing to keep in mind with this type of facility. One of the big benefits, though, is that with spaceport bonds, you avoid a problem that exists throughout the rest of the municipal bond area. And that is what I'm going to quickly call the federal guarantee issue, which is back when they came out with tax-exempt bonds, the concept was, well, if we have a tax-exempt bond and it is somehow guaranteed by the federal government, because tax-exempt bonds are tax-exempt and carry a lower rate, effectively you have a tax-exempt bond with the credit of the federal government, and that keeps and that would compete with U.S. Treasury obligations. So there's a quote prohibition, and a federal guarantee can come about in many ways, but in particular, it can come about if debt service on the bonds is paid from a lease or other agreement from the federal government. That prohibition does not apply to spaceport bonds. So, and the reason, when you think of it, is obvious. Say NASA, say Ron wants to build a facility, wants to lease it to NASA or to Space Force or whoever, right? Or that they can come, they can lease it. Those lease payments can be used to pay the bonds, and that will still be tax exempt. But finally, the big difference between a spaceport bond and an airport bond, or many dock and wharf bonds, is that those types of bonds have to be available for use by the general public. And what that means is that you could not issue an airport bond to create a terminal that's just for Ed Rojas's private G6 to use, right? You couldn't do that. It has to be for use by the general public. So by that, use by a common carrier, think a Delta or a FedEx, whatever, that is okay. Well, let's go to the space area. Last time I looked, I don't know that we have many common carriers in the space area, right? But that's not a problem with spaceport bonds, because that general public use requirement does not apply. So you can have a facility that is, let's say, a manufacturing facility for one entity that's only going to build their stuff, and as long as it's related to spaceport activities, then that's fine. It doesn't need to be a common carrier or a launch pad that's just for use by, let's say, SpaceX or whatever. That's fine.
Gotcha.
So there's a lot of special benefits for spaceports that really, I mean, in my estimation, is the most business-friendly provision of any in the municipal bond area.
Super. I guess Kostas, Jeff, Odin, anyone want to add to that?
I'll piggyback. I mean, one of the things with public finance, which is, I mean, again, for the space industry, right, with the passage of this law, this added, I mean, Barclays is estimating that this will create about a $25 billion of new capital market by accessing the tax-exempt capital market that is out there, which Odin will get into. And I just want to emphasize that this is a source of capital that simply did not exist 8-9 months ago. and for spaceport financing. So it is significant. It's a whole new market, which is kind of creating a whole new expansion of the ecosystem. To give you a sense of what this is tax exempt to simplify it is why is this beneficial? It's effectively a loan structure, if you will. I'm oversimplifying by saying that, but that saves anywhere from 100 to 200 basis points on your financing. So if it's $100 million project for easy math, 150 basis points. I mean, that's $1.5 million in cash flow savings that you get. So think about how that benefits the project. It's not just about how do I get money, right? It's about how does this benefit the project? How does this benefit the capital stack? How does this benefit the cash flow? And that's really important, particularly as Ed was talking about when you're talking to private sector. I mean, definitely if you issue governmental bonds, right, where the facility is purely a government-owned structure, or if you have private activity bonds, which is you have a private company that's in there. And as Ed mentioned, it's typically through a lease financing structure that's in there. The government entities owning the property. There's some safe harbor provisions that we can go into or reach out if you have questions on what those look like that allow for a private company to benefit into that. One other thing I want to also mention is, Ed mentioned that there's no volume cap, and to non-bond attorneys, that's probably a new language. And the comment was made, you're not competing with other limitations on how much tax-exempt bonds can be out there. So the other perspective I want to take on that volume cap is more of a policy component, is while you're not competing against all the other tax-exempt funds that are out there, it's also really a sign from the government by saying there's no volume cap about how important they view this, how important they view the space industry, and also the economic development that surrounds the space industry. So keep that in mind. I view the fact that there's no volume cap as really a signal about the importance and what they view the future of the economy to look like. So I'll stop with that and chime in later on.
Okay. Odin or Jeff, do you want to add anything at this point?
Yeah, I would just add on. I think it's important to just highlight for a moment the benefits from the spaceports perspective of this structure, because I think Kostas kind of hit on there's a much lower cost of capital associated with tax-exempt financing, and that's very beneficial to operators or tenants with leases with spaceports. But for the spaceport, I'd say there are really three benefits that are important to keep in mind when you're thinking about this tool. One is, of course, just this cheaper cost of capital can help spur private investment and tenant-driven development, across a spaceport. So that's of course beneficial. But second, this structure, as Ed kind of hit on, it requires ownership by a state or local government or a spaceport. And so what it allows is for spaceports to retain long-term ownership and control of strategically important infrastructure, even though there is private parties involved. And at the same time, while the spaceport owns the asset, the operating and business risk can still stay with the tenant through the lease. So the spaceport gets to be, public owner of these assets or facilities, while at the same time not taking on aerospace or commercial execution risk. So I just wanted to briefly mention that point because I think it's important for the spaceports that are participating just to be aware that there are some important benefits. And I'd love to turn it over to Ron too, if he has any additional thoughts on that from the spaceport perspective.
Yeah, because I think to Odin, to your point, I mean, I think it's the kind of traditional win-win-win of it's great for the spaceport because there is that long-term asset that is government owned, and I think that also has impacts in terms of de-risking for the bond holders as well. So it's great that the spaceport is able to expand its capacity. Two, it's great for the company because, as Kostas pointed out, I mean, you're you're 100 to 200 basis points, so 1 to 2% lower. I think the latest spread between taxable versus tax exempt is probably closer to 175 basis points. So that's pretty significant for the company. And in Space Florida's case, because of our structure, there are some other financial efficiencies that also go to the bottom line of other benefits. So the tax exempt financing is something on top of some other benefits that also are helping to de-risk for the company as well as the investors. And finally, for the investors, they're able to get a tax exempt interest rate, which the example I give a lot is the new terminal over at LaGuardia Airport, which was about $875 million of tax-exempt bonds. And the equivalent after-tax yield for that bond issuance for a New York City taxpayer, a bondholder, is the equivalent of somewhere between 11.5% to 12% after-tax yield for decades. So when you think about the market for bond buyers, as I said in the introduction, there is a very ready market for good deals that are out there. And I think, Odin, I mean, do you want to show that slide? I think you had a great slide that really goes through what a deal looks like from the eyes of a bond buyer.
Yeah, if I may, I just want to throw it over to Jeff first, and just to let him say a couple of introductory comments, and then by all means, let's go to Odin's slide. Okay?
I didn't want to get in the way of the great discussion on the bonds there, but I mean, one of the things that we look at too when we're looking at, innovative financing for large infrastructure projects, including spaceports, is like, what is the wide range of incentives that's available to help deliver on these projects, right? And it's in this case too, with the bonds, you're talking about, how are tenants taking advantage of that as well, or leveraging them to support tenants. There's a lot of other incentives out there that the spaceports can be looking at themselves or for their tenants to go after, and that might mean, the tenants looking at, programs that the Department of War is putting out. We're seeing, a number of new programs coming out of there where, funds that were with the Department of Energy before are going over the Department of War and are being used to create new programs to support those industries that are really critical to national security, which are, looking to set up operations around spaceports. Or, that could be looking at, how are you leveraging your relationships with your state's Department of Transportation, go after federal DOT dollars to upgrade the transportation infrastructure in and around the spaceport, or working with your utilities to go after Department of Energy money, for example, from the Spark program, formerly known as GRIP, to upgrade your electricity infrastructure in and around the spaceport. And then also, as you're looking at some of the other tax incentives too, we've had a lot of success working with airports and maritime ports in going after some of the tax incentives that were, they previously weren't able to go after before because they were not a tax-paying entity, but the Inflation Reduction Act allowed them to do that. And in many instances, they were able to claim, credits on activities that they were already doing anyways. It didn't require any sort of additional work for them. So, I think, we always try and help clients, whether they're spaceports or private sector, look at just the whole universe of different, options that are available to them, whether that's innovative financing or the other sorts of incentives that are available.
So Jeff, would you say that's kind of just trying to be risk sharing amongst all the stakeholders of just everyone's kind of contributing to make a project viable, and how that gets, I guess, translated at closing a deal of all these different pieces that you still have to have a good project to start with, but all these things make it better for getting it done and being able to sell that deal to the market.
Yeah, absolutely. Yeah, I think that's exactly right, Ron. It's you kind of go in, you look at kind of the universe of incentives that you can go after, and you you can leverage some of those other federal incentives to drive the costs of the project down, and ideally make them kind of more attractive to the market. Exactly, and also help accelerate some of these investments as well. These companies or state and local entities can ideally leverage these funds to accelerate maybe some things that were in their capital plan down the road, or more aligned with their strategic vision, but the budget wasn't in place to enable them to develop that infrastructure faster.
Yeah.
I think another benefit maybe with the governmental ownership is that I would think it could be exempt also from many local sales and property taxes, because in effect, this is governmental property that you're talking about as opposed to privately owned.
Yeah, in fact, yeah, in Florida, I mean, that is the case where if Space Florida owns the asset and it's being used for aerospace activity, then the taxpayer, being the private company, can apply for an exemption for ad valorem property tax. So, I mean, I think that goes towards the stacking of these other benefits, and eventually, and I think, Jeff, your point about leveraging state transportation funds to state of Florida space is an efficient mode of transportation. So we've got road, rail, sea, air, and space as the 5 modes of transportation. So Space Florida actually manages a program called the Spaceport Improvement Program that can be used for either common use as well as specific projects. And that goes to do some exciting things and some not so exciting things, like expanding roads and things like that, which are the non-sexy type of projects, but the necessary infrastructure as you're trying to expand the capabilities of the spaceport. So I think all those come in line to we like to use the term de-risk amongst all the various stakeholders.
Oh, I was gonna add just real quickly on to kind of what Jeff and Ron are saying is I also think, communities should be looking at it, almost as an economic development project, that not only do you have the, state and federal incentives, but the locality can also be involved. Is tax increment financing might be a possible tool that could be used, particularly if you're looking to attract more and more businesses that are going to be paying, property tax revenue, and that property tax revenues from those businesses can then be leveraged into the spaceport and the projects that they want to encourage. I think all but one state has some form of TIF financing, and there's different ways of doing that. But you talked about the other types of road projects that maybe your private company might not want to do, but maybe it makes sense to have a revenue bond or a GO bond, something outside the bond structure we've been talking about that can support that, and it makes sense. And definitely public-private partnerships in terms of figuring out how the risk, but also the benefit can be allocated. So I think it's more than just the bonds we're talking about on this call. Is my hope are the listeners are thinking about this much more larger ecosystem, and how to be a part of that financing structure, and they should be looking at all sources, because in the end you might actually need less bonds, right, if you can figure out how to fill these various parts of the capital stack. And I just think that's important.
Ron, would this be a good time for Odin to show his slide?
Yeah, I think that'd be great to look through the eyes of a bond buyer.
All right, well, let me share my screen here, and I'll just throw up a quick visual. I was going to talk a little bit from the investor perspective of what investors are looking for when it comes to spaceport private activity bonds, and in particular, when it comes to credit considerations and such. But I actually wanted to, just given the conversation we just had, include this visual, because I think before getting into that, it is important to note that spaceport private activity bonds are probably best viewed as just one component of a broader capital stack that evolves as spaceport projects mature. So as some were alluding to, spaceport development, it's usually funded through, particularly in the early stages, a mix of developer or sponsor equity, government grants, other public funding sources. And that makes sense because at that point, oftentimes projects are still proving technology, building demands, developing initial infrastructure. And so at that point, they're not necessarily quite ready for long duration bond financing. But over time, as elements of that ecosystem evolve, you can start to see long-term tenants, mission critical facilities, contracted revenue streams, things that start to fit tax-exempt infrastructure financing a lot better. So it is, I'm glad my colleagues highlighted, tax-exempt bonds definitely shouldn't be viewed as a replacement for other sorts of capital. They're more of a complement that need to be sequenced appropriately based on the particular need and stage of a given project or development. And again, depending on the project, that broader capital stack could include, grants, equity, incentives, gap filling tools like Kostas mentioned, like tax increment financing, or even subordinate capital through federal credit programs. So this visual is here really just to demonstrate that concept of early stage capital transitioning toward long-term capital as the project's being built out and risk is going down. So a really simplified path could be early stage, you have grant funding, and then you have an anchor tenant that signs a long-term lease, and then you use that contracted revenue to support a bond financing. Now, with that, I wanted to take a quick moment to talk a little bit more specifically about some of the credit considerations that are top of mind for bond investors when it does come to spaceport private activity bonds. And before getting into that, I think it's worth noting that most municipal bond investors are fundamentally risk averse. So their priorities are preservation of principal and a stable, predictable stream of interest income. And as a result of that, they tend to focus very closely on the revenue source that's available to repay the bonds. And just as importantly, what protections or backups exist if that revenue is interrupted. Now, one private activity bond structure that's probably the most likely to clear the bond market in the near term is called exempt facilities, which I think Ed mentioned briefly earlier, but it's a structure that's commonly been used to finance infrastructure at US airports for many decades. And a simple structure of that sort, the spaceport or conduit issuer, we can get into that more later, but a spaceport or conduit issuer would issue bonds to finance infrastructure, and a tenant company would enter into a long-term lease intended to support debt service repayment. So from an investor perspective, for that sort of exempt facility structure, one of the first things that they're going to look at is the lease between the spaceport and the tenant. They want a strong long-term lease with limited termination rights and ideally a term that matches or exceeds the bond maturity. And then closely tied to that is the tenant's credit quality and the essentiality of the facility. If the facility is mission critical and difficult to replace, that materially strengthens the credit. But conversely, if the tenant could walk away without much disruption to the business, that's going to be considered a material risk. And then lastly, investors will really focus heavily on downside scenarios, particularly what happens if the tenant fails and whether there's a realistic pathway to backfilling the facility. And beyond that, investors will focus on a number of other factors from construction risk to insurance to regulatory considerations and broader market dynamics. But those lease and revenue fundamentals are typically the most critical. And so the visual on the screen really just reflects a roadmap of those core credit factors. And, again, a transaction doesn't necessarily need to check every one of these boxes for it to be financeable. But the stronger the credit story is across those areas, the greater the certainty of execution and typically the lower the borrowing cost. So I know that might have been a lot. It might be a little bit unfamiliar if you haven't ever, been in the municipal bond market, which I think is probably most of the folks on the call. But hopefully it kind of gives you a sense of some of the things that investors are thinking about when they see a private activity bond, particularly exempt facility structure, come to market. I'll pass it back to others that want to add on to that.
Well, we have a question in the chat right now.
In the chat.
Yes.
Okay.
Yeah.
Forgive the late question. Are these types of bonds typically not available for pre-revenue spaceports?
Yeah, that's a great question. And I would say, as a general rule, these sorts of bonds are best suited for spaceports that have contracted revenue with a creditworthy tenant. And so if there is a situation where there's pre-leasing and there's an agreement that can be put in place before a facility is built, that could work. But generally, as I kind of talked about earlier, when it's early stages and initial infrastructure hasn't been built out, or even if you're looking at a greenfield type of structure, oftentimes the better fit is more flexible capital like grants, even public funding. I know Kostas mentioned, a number of spaceports have been partly funded by even general obligation bonds, revenue bonds, by public, by local governments. So again, it all depends on the specifics of the situation. Again, if there is a contract in place, you can certainly pre-lease facilities, and in some cases that may work in the bond market. But as a general rule, spaceport private activity bonds are best suited once you have some of that initial structure in place and you have an anchor tenant and a lease in place with that anchor tenant, or similar kind of credit enhancements that bond investors can underwrite to. Hopefully that kind of answers the question. But
yeah, I think there's one. I've got some experience with some of those type of projects too, where at least this is not necessarily kind of spaceport related projects, but in some of our other work, I mean, the market seems, and I'd be curious on your thoughts on this, Odin and the others. The markets have gotten a little bit tighter in terms of just some of the other risks that you had in your slide in terms of construction risk and really just performance of actually getting everything constructed, but two, that is going to come in at budget. And a lot of the projects we've seen, the lenders and the bond buyers want to have some level of certainty around exactly what's getting built, because uncertainty around that ultimately leads to scope creep and higher costs. So they want to be able to have not only just what exactly is going to be built, but also a GMP or guaranteed maximum price before they're going to close the financing. So a lot of this other pre-development activity that goes on, I think, would require some of the other financing mechanisms to get to a point to where the project is baked enough for a lender or a note holder or bond holder to say we feel comfortable enough to go ahead and close the financing.
For sure.
I don't know if you're seeing that.
That's a great point, and you're totally right. And construction risk, I know I didn't highlight it as much when I talked about that slide, but that is definitely one of the most heavily scrutinized elements of any transaction. So financings typically can only close when a project is at or very near shovel ready. So like you said, investors usually want to see a fully negotiated guaranteed maximum price contract, certainly a well-defined scope and schedule. They usually want to see pretty significant contingency as well. Could be 10 to 20% of project costs or more, depending on the complexity. And oftentimes, and this is maybe where you're headed as well, unless the tenant or sponsor has really, exceptional credit strength, they usually want to see some sort of completion support or guarantee to bridge remaining construction risk. And the contractor team itself is important too. I think you're totally right. Investors really are going to diligence construction. And if you think about it, it makes a lot of sense, right? They want to be sure that the facility is actually going to be built, because if the facility isn't built, it's hard for them to
there's no lease revenue coming back
to repay the lease. So construction is huge. I'm really glad you highlighted that as well.
Yeah, and I don't know with the others on the panel. I mean, if you're seeing this too in terms of, I mean, obviously it's going to be important for the spaceport, any kind of spaceport financing, whether it's a GO or tax-exempt private activity bonds, but just across other transportation and other kind of similar type of deals. I mean, we've been seeing that pretty consistent in a lot of our financings, particularly over the last, I'd say, 5 to 8 years. We've seen a lot more of those type of requirements before close.
Yeah.
very quickly, I mean, you were talking about different revenue streams. So alluding to airports, a lot of times the revenue stream is not just the leases from the Delta or whatever carrier, right? There are, passenger facility charges that also go into the financing of this. And I've heard that the FAA is looking now at imposing a launch fee on
Yeah.
everything. So I don't know what it's going to be. It's got to be high too, but that may be another quote revenue source to work into your stack there.
Yeah, I was gonna also add Odin and Ron to the question about like the credit quality, and this is still such an emerging area, right? And I'm curious how it will go. I mean, part of the question was about pre-revenue and those types of startups, but in this space, the space startup, it isn't operating out of a garage for the most part. I mean, these are billion-dollar valuation companies, and their investors, in many cases, are some of the largest private equity firms that are out there. JP Morgan just recently announced a $1.5 trillion security and resiliency fund, and I'll be curious how much of that might be going into the space infrastructure world. But a lot of them might be, I can't speak for those firms, but there might be scenarios where they're willing to provide that credit quality behind a pre-revenue project, right?
Right.
So, my point to the listener is just because yes, pre-revenue might be a little bit harder, I wouldn't just cut it off and say it can't be done. Is I would actually dig further. Feel free to give any of us on this call, on the Zoom, a call to kind of help talk through that, because there might be a way that you can get there even with a pre-revenue project.
Yeah, I think it's all about building the appropriate capital stack, right? So, I mean, there are higher yield tax-exempt bonds that now obviously you've got to be more careful about those. I mean, make sure you do your diligence on that. Even though as a most spaceports, I would think would be a conduit issuer, as we would be at Space Florida, but there have been ways to really structure those type of bonds or series of bonds as quasi equity. But yeah, we're getting down to kind of a lot of other aspects of how to structure a deal that may not be where the spaceports went ahead as being like a first deal, because those do have their own issues around trying to structure as well as sell those type of issuances.
Let me throw out a sort of a general question to each of you. Let's assume we're considering doing a spaceport. What would be the first one or two things that you need to define in order to even approach this financing structures that you're discussing?
Well, it has to be at a spaceport, right? So, if you're going to ask, like I was asked, what is the low-hanging fruit? The low-hanging fruit would be a launch pad at Space Florida, right? That would be, and credit-wise, the lowest hanging fruit would be a launch pad at Space Florida that is leased for the 20-year term of the bonds to the federal government, which no way for them to get out. I would think that would, but yes, it's got to be, the first thing is it's got to be, qualifying facilities. And then I think it's got to be economically viable.
Yeah, I'm going to piggyback on with Ed is that spaceport question, right? I mean, the low-hanging fruit is it an existing spaceport? Oftentimes I've heard folks say, well, we want to just designate our airport, local airport as a spaceport. I think it's a little bit more than that. The question is, again, if you read the statute and the amendment, it talks specifically about, a launch facility or launch site is something that is
Launch and reentry.
Yeah, launch reentry.
Launch or reentry, that's
Yeah,
licensed. So it's like, yeah, location is number one, and
yeah,
then use is number two.
right. And so the first question I would ask is, does that location have its part 420 or part 433 license that the FAA has designated that they are indeed that meet that standard, right? There's an objective connection to where that is. And so I think that's something that's important to, get into is the qualifications. And if the answer is no, right, then, and we've had this question happen, is, how do you go about getting that license, right? You're gonna need it at some point. And I think that's important, particularly because that also affects the proximity aspect of the legal test, right? You have to be in proximity of a spaceport, right? So the question is where's that spaceport, and who's legally, why is it legally a spaceport under the law? So I think that's important. And I'll kind of end my comment on this is I also think it's important, particularly since this is a new area. It's not just talking about it from a public finance component, but also understanding the space, the FAA requirements. I mean, it's a more holistic, interdisciplinary approach to doing a project. And I'd be remiss not to give a shout out to Skip Smith. He runs our space and aerospace practice group here, and he's been a great resource to be able to go to as a public finance attorney to understand the space component that we're integrating together.
I want to answer that question a little bit too from the international perspective. I know this has been a very U.S. centric conversation, but James, I want to pay attention to the Global Spaceport Alliance. There are actually there's a little known agency called the U.S. Trade and Development Agency, and they provide grant funding for technical assistance and feasibility studies for infrastructure project in emerging markets, where there is a belief that helping those projects move forward to funding and financing would help to promote U.S. exports. And I can tell you that this agency is, they've just historically looked at rail and highways and digital infrastructure. They are much more focused on spaceports now, and they're getting a lot of interest in places across South and Southeast Asia, Latin America. I think if you're an international member of the Global Spaceport Alliance and you're looking for you're trying to figure out, if you want to site a spaceport, if it makes economic sense, looking to do pre-feasibility, I would reach out to the U.S. Trade and Development Agency and see if you can get some grant funding to do some of that work, so some of that research.
Wonderful.
And Jeff, I think to piggyback on your point there, I mean, we see just spaceports as nodes, just as other transportation infrastructure has evolved. So it does get to where the economic viability is important. But I think holistically, James, to what you're asking before it's just all the other infrastructure that's required. So it's going to be more than just the pads and the GSC. It's kind of all the other infrastructure that's required to make the spaceport overall in terms of the type of services and the type of operations where it does attract kind of that private industry to be able to come in and be able to utilize those assets. And I think that ties back into a lot of those other sources of capital. So one example, Space Florida, we had about $126 million grant to replace an older bridge that, as we replaced that, it was a partnership between a number of different organizations, but that replacement of the bridge really did enable a lot of other capabilities. So that's where working with other partners and other sources of financing, which aren't necessarily bonds, but working through how to best kind of finance or fund those other enhancements that are going to be required for growth. I mean, there is a lot of other sources of capital that are going to be available.
We have a question that sort of ties to that a little bit, Ron. And the question relates to whether these bonds can be used for renovations and repairs to existing facilities.
I don't see why not. I mean, so these are exempt facility bonds, and someone else asked, can they be used for general like labor costs? And so as exempt facility bonds, 95% of the proceeds have to go for capital costs, which is generally acquisition and construction. So if it is a governmentally owned facility and they want to do rehabilitation or repairs and whatnot, yep, they can do that. Sure.
Yeah, there was a question about the definition of near and proximate to a spaceport. Getting a number of different variations to that.
This is one of those questions where if you ask two attorneys, you're going to get three opinions on what that means. And I'd be curious what your thoughts are or what other folks are. I mean, I know there's an IRS ruling that out there that provides, if you use ports as an analogy, that's roughly about 30 miles. But then I've also been involved in discussions where it might be more because, the spaceports are different. The proximity is different. Maybe a question for Ron is, this would be a very fact sensitive question is how large is Space Florida? I should know that, but I'm curious, like how wide, how large? I'm assuming.
Yeah, I'll answer it in a couple of different ways because one, from a Space Florida perspective, yes, the Cape Canaveral Spaceport, which is actually not just the NASA side, but there's also the Space Force side, so it is vast. Anytime we give a tour, it really is quite large. But in context to the legislation, Space Florida we also have in the state of Florida 3 licensed spaceports. So across the river in Titusville is also a licensed spaceport. Cecil Field in Jacksonville is also a spaceport as part of our statewide spaceport system. So I think Kostas, to in terms of close proximity or if you just connect the dots, you can almost make an argument that anything along I-95 from the Cape all the way up to Jacksonville, you're in close proximity to any one of those 3 spaceports. But I think it is much more facts sensitive to where there's an FAA definition for around spaceports, but that is really around safety. It's not really around economic proximity or just the economic impact. So I think until there are specific use cases to get a private letter ruling or something to get some assurances, if there is something testing the fringes of what that definition is, it's going to be different until there are specific regs that come out for this bond. Right. Otherwise, I would go after PLR with a specific use case to say, this is what we're planning to build, and is this in close proximity? And that way you can check the box on location, and obviously the use requirement would have to be met as well.
Yeah.
Yeah, I mean, it would depend. I think, and now I'm just analogizing, but I would think that one of the things you'd look at is whether certain facilities are somehow functionally related to an airport. I say an airport because that's where I was going to the spaceport. Because for an airport, for example, I can think of things like beacons, right? Which could be miles away, right? But are functionally related because they lead the planes in there. So you think, okay, well, now here's a functional approach as opposed to a mere proximity, right? For determining what is proximate to the launch site. The other things are, you mentioned safety things, right? I mean, there have been accidents at launch pads that have caused damage 10 miles away. Right. So you'd say, well, maybe we don't want to put a fuel processing facility closer than that. Or it
Right.
may be that you need a certain place where you have the utilities in order to build the manufacturing facility or the industrial park that you need this. And I mean, I would prefer, quite frankly, I would prefer that Treasury come out with regulations on this as opposed to, the drib and drab of people going with private letter rulings.
We haven't talked to Treasury about that, but go ahead.
Yeah.
No. I was going to say, Ed, I was really glad you said that, because a lot of folks are talking about getting a ruling from the IRS as to what does add a near, the proximity issue. And my concern with that is one, that's great, that's the safe, but those don't happen overnight. And if you're putting up a project and you're told you're going to have to wait, 12 months to get the, maybe more, and you have to wait on something like that, thinking as an entrepreneur, that's not going to be well received. And again, my hope is that, what Ed said is, I hope Treasury comes out and kind of gives it, gives some background, gives that guidance, as opposed to, as Ed said, dribbling and drabbing, because what might work in Florida might not work in Texas, and that might not work in, just in a different geography.
Yeah. And I think that's where just getting some industry insight into Treasury. I know with previous conversations with Treasury, they were still, and this goes back several years, but still trying to understand the nuances. They were starting from a base level. So I think reaching out to industry and others to understand, well, why, because of the safety buffers, that for certain types of facilities, you do need to be at least X number of miles away, just as a matter of practicality. So understanding those nuances of the industry is going to be important for Treasury to be able to make those regs. And that is something that we do intend to do. We just have been busy and just haven't had the opportunity, because some of the things that we're working on right now are not necessarily going to be testing the boundaries yet.
Yeah.
Well, look, I have just one more question, and then we'll move to sort of closing comments. Okay. And Jeff sort of teed this up a little bit earlier, but we are global. And so if you are a spaceport in Australia or Japan or South America, what would be some of the principles that we've talked about here that could be applied to that operation? Ron, maybe you could kick it off, and Jeff, if you want to jump in, however.
So the high level, I mean, we do talk. I think we've talked to a number of global members of GSA at various forums, and it's consistent with our theme of how we look at different projects and partnerships, is really trying to do the risk sharing or risk mitigation across all the parties. And obviously, you've got to have that use case for those facilities, but I think the theme of sharing risk between all the various stakeholders appropriately is the way to not just get the support for the project, but also to be able to progress things so things can get built.
Mm-hmm.
I would say, I would maybe start with the use case, especially in emerging markets. I think there's oftentimes political pressure, political drive for a spaceport for national pride reasons, and rather than economic reasons. So, starting with the use case, and if the use case is there, then looking at developing the infrastructure around the spaceport, the roads, the electricity, it merits port access if that's necessary. But yeah, I think that's probably where I would start.
Okay. And Ed, Kostas, Odin, any?
I was going to say, we were asked to provide some advice on almost this very question for a potential spaceport in Africa, and a lot of what we're talking about here, at least the legal structures, the financing structures, can be applied in the lease financing structure, what investors are looking for, the risk qualities. Those apply no matter where the projects are. I mean, what makes it nuanced in the United States is we have this tax exempt component that lowers the cost. But in terms of the overall credit quality, all those other considerations that go into a project, into financing project, into that capital stack, applies no matter where you're going on the globe. And there'll be some local nuances, but again, a lot of our conversation that we've talked about today, arguably 90% of it can be applied to, spaceport globally.
Gotcha.
One thing very quickly, when we're talking about spaceports, you don't just think launch pads and things like that. So let's throw out another big buzzword that everyone talks about, data center, right? So at a lot of panels, people talk about putting data centers out in space. Well, under these bonds, if you are at or proximate to this, you can build a facility to build a data center to put it out in space. And the reason I mentioned this is that obviously there's been a lot of attention to that right here. The president has discussed it a few times. Pretty much every governor has talked about that. And so the allure or the ability to do spaceports, I don't think is limited to the mere launching or reentry of the vehicles, but it may be even greater on the manufacturing side of what actually goes into space.
Yeah, because that goes towards, it's either spacecraft or space cargo in terms of the legislative definition, and that space cargo definition is broad enough to be, it doesn't have to be just things that are going to come up or come back or ever have to come back. So I think, to your point, I mean, a lot of different things fall on those definitions.
And one final point, the way I read it, and I have talked about this with IRS folks, I think that manufacturing that they build does not necessarily have to be for the spaceport it is next to. The facility can be close or proximate to that, but if it is space cargo, it goes to a spaceport, any one of the 16 we have or the 14 that have their licenses in, that could work.
Yeah. Odin, anything you want to add to this right here?
Yeah, in the interest of time, I'll just be brief. I would echo a lot of what's been said, particularly what Kostas was saying in terms of when we talk about spaceport private activity bonds, like we were discussing earlier. I think a lot of the specific laws, of course, are only for United States spaceports. But I would say that for infrastructure bonds and long-term capital outside the U.S., a lot of the themes we talked about are fairly widely applicable in terms of the importance of long-term contracts and risks being properly allocated. I think in terms of using a government-enabled bond financing tool that serves the public and commercial users, I think that is a concept that is can be applied more broadly, even if the specifics are different.
Okay, so with that, let's do some closing comments to our audience. Ron, let's start with you, if we could.
Sure. Well, I think this is an exciting time as we see just the importance of spaceports and those activities for not just the United States, but globally. As I mentioned before, we see it. Every spaceport is just another node in a transportation network. So we're excited to see more development happening, and just happy to see this new tool start to get to be used.
Okay, Kostas?
If you had asked me, 5 years ago that there'd be an integration between public finance and space, I would have, never thought that. So it's kind of like a Reese's Peanut Cup. You get two great areas, and now we're being able to put it together. But I think what's really, fascinating is it's creating a new financing structures. It's new ecosystems, new economic development. And I think it is something important not to just look at from, a bond financing perspective. If you're in this area, whether you're a company or a government or a spaceport, but, how is it an economic development tour for the locality? And I think that should be one of the drivers. I know in my conversations with folks over at Commerce and at the FAA, they really think of spaceports as not only supporting the space industry, but really local economic development. And I think by approaching the conversations about whether you're a company or a spaceport and you're trying to develop those partnerships, that's a very strong starting point. It's not just about space, it's about what's down here on Earth, the jobs, the tech, the infrastructure, and quite frankly, the future. So we have interesting times ahead.
Yeah. Ed?
So when you look back historically, every major airport has had financing, significant financing with airport bonds. And whatever qualms anyone may have had about the airlines being able to work with that are now gone. That is the common financing structure that is used across the nation. And I think that as the spaceport bond structure matures, you will see something similar, whereby it will become sort of the standard financing tool that will be used going forward.
Super. Jeff?
Yeah, I think, the way I see it, I see a lot of different federal incentives out there that spaceports can and should be taken advantage of. But in many instances, it's not the spaceport themselves. It's going to be the entity that's most likely to go after that funds. So successfully taking advantage of all the different programs that are available to you, whether you're a spaceport, a space park, or even a company that's leasing space, at a spaceport or a space park, is really going to depend on your ability to build partnerships across with the Department of Transportation, with an airport, with a maritime port, and being proactive about identifying, what are the right incentives for you can work with to go after that. I think the, entities that do that are going to find themselves with a lot of different options for funding sources for their priorities.
Cool. Eden, final comment?
Yeah, this has been a really great conversation. It's been, joy to be here with everyone. I would just echo, I think it's a really exciting time for the industry. I think we talked about a pretty exciting new tool, which Ron and his team helped get through last year. And I would echo what's been said. I think if it's properly structured and sequenced in the capital stack, it can be a really powerful tool, but it's certainly not the only tool, and it's certainly not the right one for every situation. And I think wanted to go back briefly to the question about pre-revenue projects. Every project and every situation is unique. I think different projects have different tools that are available that can help bridge the gap to get to financing. If you're looking at financing for a workforce housing project, that has one set of tools. If you're looking at financing for a hangar, that has a different set of tools. And so I think I would just echo what's been said earlier. We talked about some general credit factors and other things that come into play typically, but just like, many other situations in financings in life, the devil's in the details, and every situation's different. So just wanted to, to say, happy to talk offline about specific projects. I think, it's been a pleasure to talk about some of these things in general terms, but it really does, each project is unique. And so just, happy to have had the conversation and appreciate everybody's time.
Well, thank you all very much, panelists, for just a wonderful, wonderful discussion. And this now terminates this webinar. So thank you all very much. Take care.
Thank you.
All right. Thank you, everyone.